Hello, Jayson Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. The average mortgage rate headline among major news networks suggests things improved this week. The headlines are wrong. Nothing new there, really. News headlines are often wrong about many things. When it comes to mortgages, news outlets pull the data from Freddie Mac's weekly mortgage rate survey. Freddie's data is delayed by 1 week, so it is always best to reach out to someone like me who can give you the real-time information. To Freddie's credit, if I examine Monday's rates compared to last Monday's, they are lower by almost exactly the amount in the news. Unfortunately, things changed in the second half of the week. Rates rose abruptly on Wednesday and Friday following surprisingly high inflation readings in the UK and Germany. No surprise there really either. All other things being equal, higher inflation means higher rates. Higher rates abroad tend to translate to higher rates at home, albeit to a slightly different, lesser extent. That's exactly how this week played out. To get a better sense of how much worse things were for Europe, the following chart shows the absolute change in 10-year bond yields over the past 4 days for the US, UK, and Germany. As for why we care about 10-year Treasury yields in the mortgage and housing markets, this is why. The net effect for U.S. mortgage rates was a move up to the highest levels in nearly a month. That's not ideal considering the already obvious impact of higher rates on various housing metrics. All of the following charts are from new reports released this past week. The mortgage industry has already undergone a majority of its contraction in response to the rate surge. Past precedent leaves room for some more deterioration, but the sharpest changes are behind us, and let's hope that is the case for sure. For instance, in addition to the already flat refi activity, the last 5 weeks of purchase applications are hovering right around the same level. While it's not a pleasant experience for those of us in the industry, the correction in housing was and still is a logical byproduct of the unprecedented boom in prices and sales in 2020 and 2021. Even after coming off the boil, year-over-year price appreciation is still in historically high territory. The following charts are from this week's existing home sales report. The first shows the year-over-year change in the median existing home price. From the same report, you can also see that the inventory of existing homes is still treading water relative to last year's levels. The last existing homes chart shows a more linear visualization of inventory on the orange line, along with the big shift in sales seen so far in 2022. Now, clearly, inventory could stand to increase some more. Builders are trying to address that need with the noticeable shift toward multi-family housing. The following data comes from this week's new residential construction report, which provides a count of building permits for single-family and multi-family homes. One is still rising while the other has fallen sharply. One reason experts aren't expecting massive relief on the inventory front in a very short order is that multifamily construction is not being completed at nearly the same pace as single-family construction. You can see the red line, which is the multifamily, is generally flat since 2016, whereas the blue line is still trending higher. Now, if there's relief in sight for rates, it will depend on the path of economic data and inflation, the big I word, in the coming weeks. The market and the Fed both seem to be expecting a certain measure of moderation in the inflation data. So calmer inflation won't really help until it has established a track record of several months of substantial declines. At the same time, the market has been surprisingly willing to be spooked by higher inflation data, as was the case this past week. Weaker economic data has helped rates at times in the past 2 months, but weak housing data doesn't really count because weakness is widely expected when rates have risen as much as they have and as fast as they have. There have also been just as many surprisingly strong economic reports, several of them noticeably contributing to the rising rate trends seen so far in August. In the bigger picture, the Fed has put itself in a no-win situation. On the one hand, if they continue to raise rates, it will slow the economy further. And on the other hand, if they pause or begin to lower rates, inflation will continue to edge higher. Not to mention the quantitative tightening that they've promised. Without a major change for better or for worse in the economic data, it wouldn't be bad planning to expect rates to continue bouncing around in this range until the data is looking consistently stronger or weaker. So, a bit of a holding pattern for now. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.